Hey, good morning, everybody, and welcome to this Tuesday, May 14th, 2024 edition of Trading Places Live at EarningsBeats.com. I'm Tom Bowley, Chief Market Strategist here at EarningsBeats, and I'll be your host for the next 30 minutes as we prepare for another trading day ahead. This one will be a little different because we got another economic report out dealing with inflation. The PPI came out. That is the producer price index. So this is inflation at the producer level. And it doesn't always go along. In fact, many times it doesn't go along with the consumer price index, but still it is one inflation report that certainly has interest among those on Wall Street. And for April, the PPI, the headline PPI number came in with a rise of 0.5%. The market was expecting 0.3%. And if we strip out food and energy and we get the core level, we see that the core PPI came in also rising 0.5%, and that was above the 0.2% level that was widely expected. So, as you might expect, we saw an immediate drop in futures, and I'm going to give you those numbers because I haven't actually looked in the last 15 minutes or so. Actually, right now we are showing the Dow Jones up about 0.05%. So the diamonds showing green. The spider down about 0.05. So both of those pretty close to the break-even level. QQQ down about 0.2%. That's all. That's actually not bad compared to I had seen the QQQ shortly after the inflation report was out, down about $2 or about 0.5%. So it's actually doing a little bit better than it was. And then finally, the last one I wanted to look at actually is the IWM, which the IWM took a big hit when the news first came out, but it's now up 0.8%. So I'm not sure if there was any spin put on it because I didn't, take a look at it, or whether maybe there was a one-off excuse. Haven't looked into the report at all, but this is about 100% opposite of what I would have expected out of the IWM. But we'll be taking a look at that 10-year Treasury yield here in just a couple minutes, and that might give us clues too, depending on how the bond market reacted to this. Anyhow, we did get that next inflation report out. It was at the producer price level, but still it wasn't good news, but somehow the market has turned it into good news, at least at the small cap level. But we'll look at some of, like I said, look at the bond market, look at some of that in just a minute. In the meantime, and by the way, we do have the CPI report coming out tomorrow. I feel like that's a much, much bigger, report as far as our potential reactions and how the market may feel about inflation when we get the numbers at the consumer level. So tomorrow morning at 8:30 a.m. Eastern, which is 1 hour before the market opens, that's when we could have fireworks in one direction or the other. So anyway, stay tuned for that. As far as yesterday goes, we saw the Dow Jones Industrial Average finish down about 0.2%. That was 81 points. It was getting up close to its all-time high, so it took a little reprieve yesterday, fell back, especially later in the day. S&P 500, pretty much flat, lost 1 point. So from 52.22 to 52.21. Really no big shakes there. I still see this, continuing to push higher. I believe we're going back to all-time highs, and I don't think it's going to be very far away. Obviously, pending that CPI report tomorrow. Let's see what happens with that and how the market reacts. If that report's not bad and the market does have a move to the upside, I think the S&P could be an all-time high tomorrow. But we'll have to see. Let's see how that inflation report comes in. Nasdaq 100 gained 37 points yesterday, so that was up about 0.2%. Mid caps down 0.1%. They were up earlier and then they came back down. They were clearly above the 3,000 level. Came back down to 29.91 at the close. And then the IWM dropped about 0.2%. But again, the IWM was up early in the morning, sold off during the day. Now it's up again this morning, back to, 206.44, now 206.41. The 210-211 area is the area that we need to watch for on the IWM. That is not an all-time high. It is a 2024 high, though. So get back up through that 211 area, and then we could set our sights on the all-time high on the IWM, which would be up at about 236. Transports gained but did come off the earlier highs, still finishing higher by 0.2%. Got up to almost 15,750 during the day, came back down, settled at 15,629. And like I said, that was up roughly 0.2%. Still not seeing much movement in that AD line on the transport. So yesterday was not helpful because we were up much more intraday and then we sold off later in the day. And so closing below the midpoint of yesterday's trading range sends the AD line lower there. And you can see it just starting. I'll pull this up a little closer here so you can see it. But you can see that AD line hooking and turning and moving back to the downside. That was because of that reversal and finishing in the lower end of yesterday's candle. Anything below the center line of a candlestick will take the AD line down, and volume is a multiplier. So it's based on the percentage where you finish in the candle times the multiplier, and then that either gets added or subtracted to the AD line, in this case subtracted, since it finished below the midpoint. Previously, we had been going higher because we were finishing toward the upper end of the trading ranges. And even though volume was light, most of that volume was being added because we were finishing very close to the highs of the day. Anyway, I try to explain that every once in a while, the AD lines, because I do use it. I think it's very helpful. I don't think it's a primary indicator. Obviously, for me, that's price and volume. That's it. But AD lines are a secondary indicator that I do follow pretty closely. Next up is the technology group. You can see technology gaining almost a full dollar. XLK up 97 cents. That was up about 0.5%. Real estate also doing well, gaining about 0.25%, struggling at that 50-day moving average, unable to break through just yet. You can see back in early April, we had come down to that 38 level, bounced back up above 39, and then we gapped lower and just went straight down. Now this is our attempt to get back through that 38 level. And right now it's been a struggle. Closed at 37.91 yesterday. 50-day moving average coming in at 37.93. So it's just below the 50-day and also just below the first key price resistance level that the XLRE needs to negotiate. Industrials actually the worst performer yesterday, dropping 0.4%. And you can see failing at resistance. I see a cup. I see a perfect cup. And yesterday's weakness to me is nothing more than the start of a handle. A breakout above that 126, 126.50 area would measure all the way up to about 132, 133. So that is something to watch for on the XLI on a breakout. That would be another pretty nice move and would very likely coincide with an S&P 500 that's at record highs. Aluminum made another big break. This was a huge uptrend coming off of the February low, and then we went sideways in a little bit of a flag pattern here over the past 5-6 weeks. Yesterday looks like a clear break on increasing volume. So we've now got aluminum potentially moving into another leg to the upside. Autos also up about 2%, trying to bounce off of its moving averages. So we saw a few gap ups, not just in the auto index, but primarily because of Tesla. Tesla was showing these same gap ups, and the auto index follows Tesla very closely. But we have been pulling back, got back down to the moving averages. Yesterday was an attempt to move back through, although we did finish more in the lower half of that candle yesterday. And you can see the AD line has been struggling on autos as a result. Finally, airlines. So airlines up 1.82%. They've done very well of late. We've seen a few different breakouts. We saw the breakout. Well, actually, first we saw the breakout to open April, taking out the February high. Then after pulling back, we went back up, took out that early April high later in April, pulled back to the 20-day. And here this month, within the last week, we made the breakout. And yesterday was yet another high on the close. And you can see the AD line in airlines continues to be very strong. One word of caution with airlines. They obviously can have short-term uptrends. Long-term, these stocks tend not to be very good long-term investments. So I would consider them only as short-term trades. Personally, I would not be buying these stocks, planning to hold for 20 years, just because the stocks haven't really performed like that over the long term. So if I pull this chart up and we take a look at the monthly 15-year chart, I mean, you can see we had a nice run in 2013, 2014, but we were at a level in early 2015, and we're still sitting 25% below that. And if you look at where the S&P 500 has gone since then, I mean, you can see we've had a huge run up, probably more than a doubling of the S&P 500. So if you've parked your money in airlines for long periods of time, chances are you haven't done very well. So as a result, I would trade these moves when we get the moves like this to the upside on the auto group. And that's exactly what we're in right here. Just show this a little bit zoomed in there. But we've come down a few times around this 120 level. Haven't really closed a month much below 120, although you can see back during the pandemic, airlines actually were crushed and came down and put in intra-month lows that were well below 120. But we haven't seen a monthly close or open much below 120, and that's where we started moving back up again. But kind of think how much the market has moved up off of that low in 2020, and look at autos going back and testing it. Very few areas of the market have gone back down to test where we were back in 2020 during the pandemic. So again, I think it's another case in point of why you don't hold the airlines for a long period of time. But right now we are in a nice uptrend. Next key resistance is going to be up around the 190-200 area. And right now we're at 174. So we may have still a little bit more juice in this to see whether or not we can clear a significant resistance level in terms of price. All right, 10-year Treasury yield. So let's see what's going on here. Let's get an update because this, and that probably is why we're seeing the IWM return back up again in terms of its pre-market pricing. Because earlier we saw, and we're going to go into a 5-day chart, look at what happened when the PPI first was announced. So we saw yesterday we closed around 447, I believe, something like that, 447, 448. This morning we got up to 453. So we had a very quick move up in the 10-year Treasury yield as a result of the PPI report coming out. And then, of course, the IWM, which we can't see the pre-market on the chart, but the IWM, and I don't know how low it went. I know that it was up about 0.5% prior to the report. And when I looked right at 8:30 or just beyond 8:30, it quickly went down about 0.5%. I don't know how far it ended up going down, but it has now rallied back with the 10-year Treasury yield completely falling back apart to the downside. That's really surprising to me, honestly. I haven't looked at anything else. So I don't know why. Maybe there's a story out there. If you've heard something, feel free to share it in the comments. But yeah, right now it's up. IWM now is up 1.11%. It's up to 207.01. So as the yield continues to drop, that's sending the IWM up higher and higher. And so what looked like a rather bleak morning for stocks about 43 minutes ago has all of a sudden turned into pretty decent morning. So we'll see how things shake throughout the day. But watch the 10-year Treasury yield, because that has really been a pretty good guide as to which way the IWM is going. And we clearly can see how that worked this morning. S&P 500, talked about it briefly earlier, but I mean, looks like maybe a cup. Could be an inverse head and shoulder where you come down here, put in a left shoulder. Let me zero in here again. So here would be the left shoulder, right at about that, the big red candle at the bottom of that. So you're coming off of an uptrend. You go down, you mark a left shoulder. You come back up, you put in a right shoulder, or excuse me, the neckline. Then you go down here, put in the head, rise back up, potentially put in a slightly higher right side of the neckline. Maybe with the CPI report tomorrow, maybe we pull back. I mean, that's one pattern, one possible pattern where we would pull back, put in an inverse right shoulder, and then go up. And I'm looking at this as bullish outcomes for a couple of reasons. Number one, we're coming off of a significant uptrend. Normally, a continuation pattern is going to break in the direction of the prior trend. So that would be the first reason why I would be looking for a bullish outcome here. The second thing is strictly because I've been a secular bull market fan for probably the last, since we broke out in April 2013 with, only a couple of minor expectations of maybe cyclical bear markets like in 2022. But for the most part, I've remained bullish, and I still remain very bullish going forward. So ultimately, I see a breakout coming anyway. So you can call the pattern whatever you want to call it. But I see another breakout coming, and I see us going higher into year end. That doesn't mean we won't have a pullback this summer. And potentially, I wouldn't be surprised to see one that's maybe a little bit more significant than some are expecting, just because of the uncertainty over the political race and how that's going to develop over the summer. That's typical. I'm not just talking about it in today's current political environment. That's typical in presidential election years. So when you look at that cycle, probably from around July, August to maybe the latter part or middle part of September tends to be pretty weak. And that's the case every year, to be honest. Mid-July to probably around the 26th or 27th of September, that's the weakest time of the year historically, dating back to 1950. And no other period's even close. So the presidential election cycle is maybe very similar to that, except I think maybe we tend to see a little bit more weakness historically during a presidential election year in those late summer months. So down the road, I think we could break out to all-time highs. We could have a run here for the next couple months, and I'm not talking about a big run. I'm not expecting 5,500 or 6,000. I'm not looking for something like that, but I wouldn't be surprised to see the market get back through 5,300, maybe get up to 5,400. Outside shot at 5,500. But then I think we'll see weakness and then a strong finish into the year. But anyway, this is what it looks like right now on the S&P 500. Moving on to the Nasdaq 100. Pretty much the same type of chart. Again, is it an inverse head and shoulders? Is it a cup? Maybe a handle forms after, maybe we get up to the high and then we get a little bit of a handle. I don't know. Maybe we get equal highs and we'll come back down one more time and put in a higher low, and we'll have equal high and higher lows, which would be an ascending triangle. Something like that's possible. And the worst case scenario for me would be sideways consolidation, where you go up and you go back down, you go up, can't get through, you go back down, test the lows, which would be, in this case, back down to around 17,000 on the Nasdaq 100, and then ultimately break out from there. Don't know which way it's going to go, but whenever I see this uptrend, I start looking for potential patterns. And the key to the patterns, in my opinion, is that they provide us measurements on breakouts once they execute. So it's not when you see a pattern that matters, it's when they execute that matters. So I've been told during many different times throughout this secular bull market that, we got a head and shoulders top in play. Well, until it executes, I'm not really worried about it. To me, that can also mean just kind of like sideways consolidation for a period of time. And it may look like a head and shoulders, but you have to have that break below support in order to really be concerned about a bearish pattern like that. All right, let's go on to the IWM. IWM, like I said, yesterday reversed. Actually, last 2 days we had gap ups and reversals. Today we're gapping up again. Do we reverse again? Or is this the day maybe where we put in a solid hollow candle and go all the way back up to that 210, 211 area? If we're opening at 207, see latest here, 207.15, now up 1.2%. If we're opening up above, this recent congestion area here, is this maybe the top for a inverse head and shoulder pattern, where maybe we'll go back down, put in a, right shoulder, maybe at the moving averages, or are we filling out this cup? This doesn't look as much like a cup to me, because the uptrend, it's almost like the uptrend ended in December, but we did go a little bit higher, but just drawing from the bottom to the top up here just kind of looks a little strange, but it's still an uptrend. I'm not sure if we get all the way back up to that 210, 211 area. My guess would be yes, that we do go back up there. It's really a lot of these patterns and all going to depend a little bit on what happens tomorrow, quite honestly, with the CPI report. I think outside of jobs report or outside of a Fed announcement, I would say the CPI right now ranks as probably the third biggest economic report that we get. And you might even argue that it's higher than the Fed or the non-farm payrolls, at least right now, because there's so much attention on inflation. So if you tell me what the CPI report's coming out tomorrow, I could probably tell you where I think the market's going to be. But although that was not the case with PPI, but personally, I don't follow PPI nearly as closely as I do CPI. I mean, if you look at the two long term, PPI has a lot more fluctuations, even at the core level, than you see in the CPI. CPI tends to be much steadier. PPI is all over the place, and the headline numbers really all over the place. So you just can't. I don't see the same correlation to how stocks trade based on the PPI as I do versus the CPI. Anyway, transports. There's the transports chart. I mean, still overall, we're kind of in the middle of a range, but looked pretty bleak probably 3-4 weeks ago. Now we've improved. Now we're back above the moving averages. Now the PPO is trying to go positive. I mean, it's just been this back and forth with transports, but clearly transports have not done as well as the overall market. So they've been lagging, which is, it's just a little bit of a caution flag, if you will, about where our economy is going, because that's all transports really care about. If we're going to be shipping more goods, these stocks will go up. If we're going to be shipping less goods, these stocks will go down. And so anytime I see struggles with transports, it makes me think, at least based on this chart, it makes me think negative thoughts on the economy going forward as far as, slowdown versus strengthening. And so right now, I think what a lot of traders, the message I think that is being sent to the Fed is that don't forget about the economy. I know you've got this inflation on your, that's on your wish list, get that inflation, that target level back down to 2%, but we're heading back down there, and don't spend too much time, making sure inflation is in check, because you're going to lose the economy. I mean, that's kind of the message I get when I see a chart like this. Personally, I think the Fed's will lower this year, at least once, I think still probably twice. I might be in the minority with that thinking, but I guess we'll see what happens. And by the way, I've been wrong on the timing of what the Fed's going to do for the last couple of years. I mean, I thought they would stop hiking long before they stopped. So I haven't exactly been the go-to as far as what the Fed's going to do. And I just sit back and watch them and chuckle because I do think this Fed is maybe the exact opposite of transparent. I'm not quite sure what they're going to do from month to month or what they're going to say, which is probably more important at this point. Anyhow, that was transports. Let's move on to the chart of the day. So for anyone who is interested, here at EarningsBeats, we do have our EarningsBeats Digest newsletter, which provides 3 charts of the day throughout the week. We have one on Monday, Wednesday, and Friday. If you'd like to receive those free of charge, no credit card, you can unsubscribe at any time. Name and email address is all it takes. Hit that subscribe button. We'll get you set up. I spend a lot of time there talking about relative strength, earnings gaps, predicting earnings based on relative strength, seasonality, sentiment, and then, of course, many of the normal technical analysis tools that many use, at trend lines, moving averages, technical patterns. I mean, all these things are highlighted in here. I think it's a great educational resource for anyone at any level of trading. But simply sign up for that, name and email. Yeah, that's all it takes there. All right, chart of the day today. This was a chart that I sent out not that long ago. It was probably last week, maybe last Monday, Wednesday. I'm not quite sure. It's been out recently, but I loved this breakout on Moderna. This is a stock. Remember, it was one of the darlings during the pandemic. So if we went back, 5 weeks or 5 years on a weekly chart, you can see the huge move. We went from probably about 12.5 to 500 during the year and a half after the pandemic. And then it's been this slow, steady decline for quite some time. Well, now we've got this, and each time it seemed like we would get lows and then we were unable to break above the prior high. So we just had this pattern of lower highs, lower lows, just continued and continued. Well, that actually started to change with this breakout that we saw last week on the daily chart, taking out the high from the beginning of the year. So let's go back again, take a look at that. So here was that breakout. You can see down below the volume that accompanied that breakout. And so in the EB Digest that I sent out last week, I said that this has taken on more of a bullish character on its chart. But I said if you wait, you could probably get in a little cheaper. And I thought the 115, 116 level was going to be the first area of support. And then I think at the time, wherever the 20-day moving average was, it may have been back down under 110 at that point, something like that. But anyway, those were a couple of levels on a pullback to take a look at Moderna. And you can see over the course of the next week or so, we did pull back. Yesterday's low, or not yesterday's low, but Friday's low, we got down, below, I think just below 117, down into the 116. So that was pretty nice drop after almost hitting 130 a week earlier. So it came down probably about 8-9% on that pullback yesterday, right back up to the high again. Now, it looks like we made a slight breakout on that high. And the other thing, look at the AD line here. AD line's been strong throughout. So even when we were pulling back here, look at the AD line, keep going higher. Pulled back, went up to another high. Pulled back, kept cruising up to highs. And then when we break out, we make another high. So it looks to me like the stock's been accumulated for a while as well. And so anyway, Moderna looks pretty good. I wanted to talk about inflation for a minute because we just got the producer price index out. And I wanted to spend a couple minutes just showing you at Stockcharts how you can track this. And it's really, I think, kind of powerful. And it gives you the numbers, organizes the numbers of the PPI for the last many, many, many months, however long you want to go back, really. But first thing you do, I typed in, and want to make sure you can see this. This is $, CPPI, core PPI. So if I just wanted the headline number of PPI, I would just take out the C and I would update. And there's my headline number. But I wanted to look at the core for now. All right, so there's the core. But you look at it, and this is a 1-year daily chart. Well, the PPI comes out monthly, as does the CPI. So the first thing just makes sense is to change this from a daily chart to a monthly chart. All right. Next thing, what the heck's PPO mean? PPO doesn't mean anything on this chart. We'll get rid of that. The AD line, we don't have volume. AD line is not going to get calculated. But what we do want is the rate of change. I want to know the rate of change over a 1-month period. I want to know what that 1-month rate of change is. And then I also want a rate of change going back 12 months. So I have a full year. And then I change the height because this is an important part of the chart. I want to kind of stand out there. Moving averages on the PPO. I don't care about moving averages on the PPO, so I get rid of those. Volume, there is no volume. Get rid of that. And then what we're left with is basically how long do you want to go back? Well, I'm going to take it back 50 years and take a look at what's going on here. Now, this gives you the monthly. I was saying how it's much more volatile on the monthly chart. If I pull up the PPI without, core, the headline number, you'd see even bigger numbers. But here is the rate of change. Actually, I'll show you that real quick. I mean, look at some of these numbers on the headline number. I mean, here it goes up 2% 1 month. Here's 1.5, 1 3/4. Here's 1%. I mean, look at the gyrations throughout. I mean, the core CPI kind of remained pretty flat. But you get to the headline PPI number and it's all over the place, which is why when we get a headline number that's way, out of kilter and above expectations or below expectations, I just ignore it. It's noise. Because, I mean, look at the chart. How can you say whether a high reading or a low reading is going to result in inflation or deflation or disinflation? I mean, you can't tell. It's all over the place. So I tend to ignore it. Now, even getting down here to the 1-year rate of change on the headline number, look at, I mean, it looks like we're going into inflationary periods all the time. Had a big jump in 2008. Of course, in 2021 and 2022, the annual rate of headline PPO got to 22%. That's pretty crazy. Then it went down to minus 10%. Now it's near flat level over the last 12 months, but that's at the headline level. So this is why the Fed strips out food and energy, because food and energy are incredibly volatile. So when you go to core CPI, the numbers all of a sudden start to smooth a little bit better. They start to be a little bit more meaningful. Can you imagine the Fed reacting every time food prices go up and down, or every time energy prices go up and down? I mean, the Fed wouldn't know what to do. We wouldn't know if we were in a dovish period, a hawkish period. We'd just be getting whipsawed all over the place. That's why they strip it out. A lot of people don't understand this, and they think, oh, the government's playing games. Yeah, inflation's coming down, but they haven't looked at food price. Well, if they have looked at food prices, they've stripped them out. The reason they strip them out is because food and energy has a long-term history of going way higher and way lower in short periods of time. I mean, you get a drought, takes out certain, farms or whatever, and all of a sudden you get prices of fruits and vegetables that go through the roof. I mean, there are just things that we can't control, that where the volatility is just all over the place. So anyhow, it makes sense to strip out the food and energy, to take a look at the core PPI and core CPI. Here you can see core PPI did have readings up around 1%, which we saw also in 2008. We saw it in 1998. We saw it back in the mid 80s. And of course, we saw it for sure back in the 70s. But for the most part, we tend to keep the core PPI below, I would say, around 0.5%. And we are generally positive. We do have some times where we go a little bit weaker, but then come down here, you've got the annual rate. So here's the annual rate, which had jumped up to 9%. Core PPI was up to 9%. We're in the twos right now. So 2.24%. Now this is as of March. So this does not take into account today's reading, which came in at 0.5%. So that is definitely going to send this up higher, because if we go back, here's the 1 month readings. If we go back to the beginning of, or to the April of 2023, we were probably somewhere down around 0.3. So this 0.5 is going to bump it by 0.2%. So my guess is we'll probably be somewhere, and I didn't look yet, but I'm assuming our annual rate's probably somewhere around 2.4, 2.45, 2.5 maybe. Somewhere in that range is where I would expect annual core PPI to be after today's report. And Stockcharts will update this. I'm not sure if it'll be tomorrow. Probably will be tomorrow. We should be able to see that number for ourselves. Now, if you want to look at the CPI, let's first look at the headline number CPI over this same period. Now, this is the report that's going to come out tomorrow. Here is the headline CPI, and you can see that got up over 8%, and right now it's back down in the threes, 3.48%. But again, look at the volatility. It's not staying near that 2% level. It's had many times where it's gone up 4%, 6%. We've had occasions where we've gone negative or we've gone flat, all over the place. You can see that those individual readings all over the place. Now let me strip out food and energy. So core CPI. Now it's starting to look much smoother over time. And you can see we had the big drop with the pandemic. Obviously, demand was gone. So we had the huge drop. And then we came roaring back because we had lots of demand after the stay-at-home was lifted. We had lots of demand and we didn't have enough supply. And so that triggered a big increase in the CPI. And this is at the core level. But look at what's been happening over the last 3 years, that the monthly readings have been steadily coming down. So if we jump back up to 0.6 or 0.8, that would spook not only the market, that would spook me a little bit. I'm not looking for that. I'm not expecting to see that kind of a jump. So I think the market, obviously, if we had a big number like that come in, that would probably send the market lower, because the CPI, core CPI especially, is what the Fed uses and watches, and mostly what market participants pay attention to. But if you look at the annual rate of inflation, we have been dropping now for, we've gone from 6.6, 6.7% down below 4%, 3.80. So how far do we need to see this go down toward 2% before the Fed feels comfortable cutting interest rates? That's really the question right now. That is the question. You know, the Fed keeps saying, well, we got to get closer to that 2%. We need to make more meaningful headway to that 2%. 2 years ago, 3 years ago, it was just, we just needed to stop moving higher. We need to start turning lower. That's what they wanted to see. And of course, we've turned lower and gone down for more than 2.5 years probably. And the Fed's still talking about, oh, we need to get closer to that 2% level. So when I talk about the Fed not being transparent, that's what I'm talking about. You know, and I get it. This is a pandemic. There was a pandemic. We hadn't seen one of these in 100 years. It's not like the Fed has a playbook for how to handle a pandemic and a health scare like we had. But I don't know, 3-4 years later, I would think they should be getting a little bit better handle on it and maybe know and let folks know exactly what it is that they need to see. I'm still not sure. I mean, if tomorrow we come in at 0.1 instead of 0.3, is that going to be what the Fed's looking for? Is that it? Or do we need a couple more of those? Or do we need to see this dip into the 2s? I don't know what they're looking for. And if you do, share it with me. They're very, I don't know what the right word is, but evasive, maybe. I don't know if that's the right word, but I'm not sure what they're looking for. And that's where, you know, from a transparent perspective, we should know. We shouldn't have to wait to hear from them for them to change their story to find out what's going on. And anyway, I feel like that's the case. Anyway, we ran a long way over today, but I really wanted to talk about this inflation a little bit because we are getting the CPI report out tomorrow. And you can see over the last year, we have not had a reading. Well, maybe 1 year ago, I think the reading was around 0.47. Since then, we've had every reading below 0.4. And if you go back in time, that's where the lid has been basically for many, many years at a time. Once we go below 0.4, I think what I'm looking for anyway is for us to stay pretty much below 0 and 0.4. If we had 0.4 every month for 12 straight months, that would be 4.8% inflation, too much. But you can touch 4.0. You just don't really want to go much above 4.0 0.4 in my opinion. But we'll see what happens. Anyway, let's see what the market's doing. We've been open 10 minutes now. We got the Dow up 66, S&P up 3, Nasdaq up 21. And there you can see the small cap still up over 1%. VIX up a little bit with the market up. So maybe a little bit of fear with that PPI report coming out, but still very low. I'm comfortable with the VIX staying below 17. 17 to 20 starts to just make me a little bit more nervous. But as long as we're below 17, especially if we move back down below 13, that is most likely. I mean, again, there's no guarantees, but a VIX down in the 12s, 13s, or even lower almost assures you that prices are going higher. The S&P 500, I mean, I'm not talking about inflation prices. I'm talking about stock prices. So I'm still seeing things. Maybe I'm looking at it with rose-colored glasses on. I know there's a lot of bears out there that think that's what I do. And that's fine. Everybody can make their own choice. But I just look at my own signals and I pass them along, and you can do with them what you want. But it's hard to bet against this secular bull market. And I think over the last few years, I think that a lot of folks who have remained on the short side or remained bearish have seen exactly what I'm talking about. Market just keeps its head down, keeps moving forward. Anyway, that's it. Later today for our members, we do have our Max Pain webinar. So once a month, we do this, taking a look at all the in-the-money options to give us some clues about where some of those big stocks might head between now and Friday, maybe even into the beginning part of next week. So it's one of our more powerful webinars. Again, if you take us up on that 30-day trial right here, you can come into our Max Pain webinar later this afternoon. It is members only. But outside of that, wish everybody a great day, and we'll see what happens with the CPI tomorrow. Happy trading.